Let's go.
G'day, listener. Welcome back to the Superman podcast. In this episode, we've got Lionel and myself, Matt McKay. We dive into the critical aspects of estate planning. We discuss key considerations, practical tips, common pitfalls, ensuring that you leave a legacy that reflects your wishes. From understanding wills, powers of attorney, to exploring advanced health directives and the implications of asset distribution, taxation, what effects it has on social security as well. We also tackle the sensitive and timely issue, how to protect your estate from financial abuse by other family members. So with that, I'd like to welcome Lionel. What's been happening, mate?
Plenty in the world of financial planning at the moment with a busy business, but never too busy to take on any new clients. So, but today's topic is probably one of the topics that is sort of the last phases of life, really. And to be honest, it's probably one of the best phases for an estate planner or a lawyer, because a lawyer in particular are happy to chime in and add their lawyer fees to their estate. And lawyers make lots of money.
Some value as well.
But at the same time, if you don't have the right structures set up and the right estate planning, it's crucial because it helps you manage and preserve your assets during your lifetime and after death. You know what I mean? It provides clear instructions on how your estate should be handled when you've got a decent will in place, which can prevent, most of the time, what we're trying to prevent in this area is conflicts among family members. Family members create conflicts about, I want this, I want that, you know what I mean? And people who pay for the whole estate consideration there is your estate that you've created. The wealth that you've created over time is going to pay for your family members fighting about how much money I should get and how much money they should get, type thing. So having an effective estate planning plan in place reduces the stress on your loved ones, and especially it's a really a sensitive time and a difficult time throughout the course of your life. But yeah, Matt, let's before we get into it, how about you hit us with our disclaimer, and then we can just shoot it out and help some people understand what the F is estate planning.
Before we get ourselves in trouble, warning, information you will hear in this podcast is general in nature, and we've not taken your personal situation, objectives, or needs into account. Both Lionel and I are licensed through Axes, and if you'd like any further information, visit our website or give either of us a call. So let's break down some of the key components of estate planning. The most basic element is your will. So this is a legal document that specifies how you want your assets distributed after you pass away. It allows you to name an executor who effectively they manage your estate. So once you pass away, all your assets move into an estate. So an executor manages that. And a guardian for possibly any children under the age of 18 that need some help.
Yeah, absolutely. And it's important to note that without a will, the distribution of your assets will be determined by the state of law, which obviously might not align with your wishes as well, Matty. You know what I mean? That's a pretty scary fact that you've been working all this time throughout the course of your career. And by the time you pass away, and if you don't have a will in place and it's premature, then all that hard work that you've done throughout the course of your working career and the wealth that you've created can go by the direction of someone at the state of law. So this is known.
Someone else makes a decision, right?
Yeah, this is known as dying as intestate. And the thing that sort of counters that makes it in your wishes is having a will that ensures that your specific intentions are followed. So the will is going to spell out to the court of law, or whoever is administering your will and your estate affairs, what are your wishes and what you want to have happened in your estate plan. Who would you like to receive your funds? How, when, and why? So,
I think also touching on this, Lionel, as part of your will, is there are cheap and nasty ways to get this done. I think it's $21 online. You can get it done
yeah,
through some law society or something. I've seen cases where some of these wills have been invalid. They haven't had witnesses. They haven't been dated all on the same day.
yeah,
Even my parents went to go through and do one the
yeah.
other week.
We
And I
might,
was just like, oh my, can we not go to a professional? I was like, I'll pay the fees. Let's go to someone special because it's going to save me time and bloody paperwork.
yeah, exactly. Like we should outline to people as well, to the listeners that are listening in, that we are not experts in this field. This is a
Not at
field
all.
that's handled by an estate planning lawyer, which is a specialist lawyer in that area. Any sort of Joe Blow lawyer, they say they can do it, but if
Mm.
you're not practicing in this area religiously and you're doing it every day, then maybe you should hand it over to someone that's got a full handle grip on the reins and how the world of estate planning works. Because to be honest, it can be a very costly exercise when you're using the wrong people and you haven't had the right things set up in place. And at the same time, when you've set up a will and you've set executives in place and you've set out sort of your game plan when you've passed away, most of the time, you've actually had those conversations with the people that are actually gonna potentially cause the estate a lot of money, and what we mean by that is if your estate is contested because you don't think you've got a fair go, you're gonna go and contest the will and say, "This is not yada, yada, yada. I want a
Fair and reasonable. Yep.
fair and reasonable." But if you're having those conversations up front with those people, they're expecting to receive certain amount of money, and you're explaining to them to the reasons why that you're going to receive those pieces of money, then it makes it a easier, a softened blow without actually having to sit in court for a long time.
And a legal professional will be able to navigate that with you. They'll be able
Yeah,
to tell you what to put in the will, what to leave out.
and
There's
they
certain
articulate it.
examples. Yeah.
Yeah, they articulate the components and the legal components of the estate plan really well. It makes your life easier to understand, and that's sort of their obligation as well to help you understand what you're actually getting yourself into. What are the components of the will? Who's responsible for each component, and how does each lever work with each lever type thing? So it's a common area that we sort of see in financial planning is that no one really has a will, and
Yeah.
most people don't even have beneficiary nominations, Matty.
On their
Like
super funds.
on their
Yeah.
super fund, that's
Yeah.
sort of like a key thing with like the superannuation funds. That's probably another conversation in itself. It's around most of the time if you've got an industry super fund that you've never chosen an investment option for, more than likely you have never put a beneficiary nomination place. And at the same time, a common thing that we do pick up in the financial planning world is like mum and dad have got a super fund, for example, and then their adult kids are old enough and they've moved out of home for as a scenario. Most commonly is that it's like, for example, the husband, for example, wants to give 60% of his wealth to his wife, or obviously
Yep.
the wife, in that sense, under the superannuation rules, can receive all of the funds tax-free.
Yep.
But he thinks it's a good idea to give Tom and Julie, his son and daughter, 20% of his super
Each.
fund each.
Yep.
Now, the biggest issue that we find with this is the nomination of beneficiaries. If they're interdependent relationships, which means they're living out of home and they're technically financially dependent on themselves, then there's an independent relationship. Now, if you look inside your super account, most of the time, the money that you put into your super is usually taxed at your concessional contribution amount of tax, which is
Yep.
15%. Most people these days. So that creates a taxable component of your super fund. Now, when we look at the estate planning side of it, Matty, an important piece to look at there is, well, if those two children are going to receive part of his super fund, then they're actually going to be paying a death tax on those
On the
inherited.
taxable component, yep.
Yeah. Whereas if they had an arrangement in through the will where the money would be paid to the wife, instead of paying it to the kids, it's paid to the wife, or the money goes to the wife tax free. And
Yep.
then they could outline between the wife and the husband how much money they'd like to leave to their children. You
Well,
can,
the kids might receive some cash from his bank account, because they receive that tax free, and then the wife can receive the super tax free.
yeah,
That's how it gets distributed. The different assets have different tax consequences, which everyone needs to be aware of when going to seek legal advice to say, hey, are we working with our accountant, our financial planner, and our lawyer to get this estate planning and our wishes down pat?
yeah. So yeah, it's a pretty key component in estate planning. You're creating all this wealth throughout the course of your life. You don't want it to go by the wayside and just go
And
down.
make sure your legacy continues, right?
Yeah, exactly right. And you want to give it in the most effective way as possible without having to pay tax on funds where you don't need to pay them. And that simple scenario there is just having your wife set up as a 100% beneficiary. The money gets paid to her 100% tax free, and then she can decide how much money they want to pay to the kids. And that's a sort of a thing
Yeah.
between their relationship and the will. So yeah, it's a pretty important area that sort of gets passed by the wayside, that most people don't really understand the areas of it as well. It's just like financial planning. Not many people know or
Oh, yeah.
understand
Yeah.
understand the concepts of financial planning, superannuation, investments, pensions. And it's the same thing with the law. Lawyers make up
Yeah.
the law, and the lawyers get paid by administering the law. So,
Yeah.
but yeah, that's a key one there, Matty. So, what
Next,
else?
next up, we've got power of attorney, mate. This is the document that appoints someone to make financial and legal decisions on your behalf if you become unable to do so. There are different types of powers of attorney, Lionel. There's general power of attorney, which is only valid whilst you have capacity. Sometimes this gets put in place if you go overseas and you might make me power of attorney to make some business decisions for you, and sign off on your behalf until you come back in the country. But the most important one for most of our clients, Lionel, is enduring power of attorney, which remains in effect when someone loses capacity to make decisions for themselves. So we see this a lot as people get older, maybe dementia kicks in, they move into an aged care home, but they've got superannuation, they've got all these term deposits, and they've got a house, and someone has to administer that and make decisions. And if someone doesn't have the mental capacity to make those decisions, someone needs to be able to come in.
Or even to the case, Matty, like for example, like the enduring power of attorney is particularly a very important document because it ensures that someone you trust will manage your financial affairs if you're no longer able to do so while you're in Australia. And that's the big point. While you're in Australia, you can do so. When you're out of the country, you can't do so. So you can include things like paying bills and managing investments and handling property transactions and all that sort of stuff. And while you're out of Australia, you can't really do a lot of those things. You know what I mean, like if you're living over in Thailand, for example, in Bangkok, um, I've got a scenario for a client at the moment that where, for example, a lot of his wealth is here in Australia, and he's got an account-based pension or a super account here in Australia, and he wants me to go and help him with his super and pension funds. And I'm
Yep.
like, mate, you can't. We're very limited in this space. Limited into the advice space because you can't even talk to the bloke seriously.
Yeah,
From an
yeah.
advice perspective, you can't
It's
even
crazy.
you can't even tell him yes or no. I can help you. I can't help you type thing.
Yeah.
But this guy in particular is living in Bangkok for the next 5 years. He's sort of part-time working part-time, enjoying himself in Bangkok in Thailand,
Good.
as you do. And I'd imagine there'll be a few people that are doing this. But
Yeah.
anyway, nonetheless, he needs advice because he needs no one. He's advised that he's previously working with has left and sold his practice and left him in the lurch. And he's like, what
What am I doing? Yeah.
do I do now? He's like, well, so I said, mate, I can give you help, but there's limitations on what I can do and how I can help you. But secondly, to that, there's another alternative to this situation. If you do have an enduring power of attorney, then that's your financial means to help you manage your financial affairs here
Yep.
in Australia, as long as it's
The
certified and stamped.
general power of attorney. Yep.
Yeah, so we've got the powers of attorney there that we're going to use to help him manage his financial affairs with his superannuation funds here in Australia. If he came back to Australia, then it wouldn't be an issue. But
Yep.
while he's out of seas and if he wants to get advice, then we have to go through these measures to make sure that one, he can get the advice, two, the appropriate advice, whatever it's going to be, and three, signing off on the advice to say, yes, this
Yeah.
is what I want to do. These are the actions that I want to take after our advice has been given. So powers of attorney are really important and they can come into the handy a lot in this situation. And
Yeah.
particularly when you're leaving overseas. Going overseas, you can't do much when you're living over in Europe or you're traveling around Europe.
But I think the other one is for us, some of our older clients losing mental capacity, having someone, a family member or a loved one, someone you trust, like you went through, that's able to make these decisions on your behalf. Because otherwise, the alternative is a family member or loved one going to court, spending thousands of dollars to try and get this done,
Yeah.
which is not a fast process to go through the court system. So, but next up, Lionel, we've got another critical component, one that sometimes gets missed, is Advanced Health Directive. This document outlines your wishes regarding medical treatment, healthcare decisions if you become incapacitated. It includes instructions around life, donating organs, whether people turn off life support, things like that. Even down to aged care, whether you move into aged care or have in-home care, all that type of thing.
Yeah, an advanced health directive ensures that your healthcare preferences are respected even when you're not able to communicate them. It also relieves your family from making difficult decisions during emotional and challenging times. You know what I mean? So, yeah, I don't know about you, but it's a bit of a sensitive one for me as well. It's like, your organs, do you want to give your organs away? Do you want to give that away? Do you want to do this? And when you have this in place, it sort of eludes all of those questions and just says, what does he want to do?
It's black and white, right? No one
It's
can do
black
that.
and white.
Yeah.
Like, don't touch my nose, man. That's pretty nice. I want to take
You can have mine. You can have mine.
I want to take that with me to the afterlife.
But yeah, it's critical. I see again, come down to our elderly clients, Lionel. They get into this space where decisions need to be made, and having an advanced health directive is critical to this, and kind of keeps the family together as well, rather than having arguments. Save that for having arguments around money instead.
And mind you, while these aren't significant things like this, for example, like from a financial perspective, they are pretty small little things that you should have in place just to save you from having any issues within your family. You don't want to create this family, create all this wealth, and then
blow it up.
Blow it up when you haven't had the right information and plan in place to spell out what you wanted to have involved for your estate planning affairs.
Yep.
So, I think it's pretty crucial. So I reckon it's always an awkward question here, but what do you want to do? Oh, yeah, just give it all away to them.
Yeah.
So I'm like, mate, do you know what you've put into your system to be able to give it away?
Yeah, who's going to take it?
Down a bloody broken down old V8. It's had a fair bit of wear and tear on it. The organs and stuff like that. Like, why would you give that to someone else?
Yeah. They'll find something. Maybe the skin or something.
But that's just a joke to have with someone when they're going.
So
you want to make you want to make
Yeah,
this whole process a little bit lighthearted as well. It is a very serious
100%.
area, and it's like a dormant area that you don't really want to talk about. But
Yeah.
if you do crack a few funnies here and there, like it
Mm,
makes it a little bit lighthearted, and everyone sort of can see the other side of it. And that's probably what our sort of role is there, Matt, is like we
break that
identify
ice.
these, yeah,
Yeah.
we identify, mate, you need to get this shit sorted. It's pretty important. It's not going to affect you, but it's really going to affect someone else.
Yeah.
It'll affect your family members and your kids and stuff like that, and your grandkids. Just pay a little bit of money to get it done. You know
Yeah.
what I mean? So
But
yeah,
yeah, it's really important. I think it provides the peace of mind, which we have been talking about, knowing that your affairs are in order, that your loved ones are taken care of, which you've just mentioned. Um, and it can provide a great sense of relief having everything in place.
yeah, exactly right. Yeah, estate planning. It also helps in minimizing the potential for disputes amongst your beneficiaries, kids or loved ones. You know what I mean? They're the sensitive souls that feel entitlement to what they think they should have at
Yep.
different points in their life, regardless of how much contribution they've made to the family or not. You know what I
Mm,
mean? But in saying that, clear instructions can prevent misunderstandings and conflicts. It lays it out in black and white, which are commonly common when there's ambiguity among assets and distribution of funds to
yeah,
whoever it's going to go to. You know what I mean? So yeah, it's a bit of a sensitive area, the old estate planning.
it is.
But
But I think effective state planning, like we've spoken about, can also help reduce the tax burden when different assets are distributed differently. Like we've discussed around the superannuation part, whether the kids get some cash from the bank account and the wife gets all the super. Properly structured plans can take advantage of these tax benefits and exemptions, ensuring more assets are in the hands of the beneficiaries rather than the government. We love the government, don't we, Lionel? But we would
yeah,
prefer to have more money in our pocket and our clients' pockets than the government's pocket.
that's why we have a job, Matty. We're trying to keep our clients' money within their family groups rather than paying it out to the tax office for unnecessary
Yep.
reasons where you can
And
prevent.
we're all for paying fair tax, Lionel,
Yeah,
but
it's not
just not
tax,
excessive.
it's not tax minimization, but it's tax effective planning to a degree without breaking the laws, but working within the laws, Matty. That's what we want to do. So
Yeah.
let's not forget about the impact of Centrelink and social security benefits.
This is a big one.
So strategic planning can ensure that your beneficiaries' entitlements are not adversely affected by the inheritance they receive. So, Matty, just
Give you
spell it
examples of
out
this.
for us in plain and simple.
Yeah.
What the F does that mean?
So we've had a few clients recently, Lionel, where the beneficiaries of the estate
Mhm.
are on a disability support pension.
What's that mean? But just spell it out to me. What's a disability support pension?
So someone that's disabled, they can't work.
Yeah,
They get paid by the Australian government,
yeah.
$1,000 a fortnight. So it's not great. It's not good. You can't live off
In-
26 grand a year.
It's an
But
income stream, but
and the added benefit is all their subsidised medications and healthcare benefits. That's really the kicker for people on disability support
yeah,
pension. So if they receive large sums of assets from the state, they may get kicked off the disability support pension from Centrelink, which then affects all their health benefits and things like that. So
in what case
really,
would that be? Like, well, give us an example.
what case?
Yeah, like just give us an example. What have you dealt with this recently?
Yep. So we've got one at the moment where mum's passed away, son's in his 50s. He's on disability support pension because of things that have happened in his life, some trauma events. He's on high doses of medication, things like that, which are covered under PBS and also get discounts when you sit on disability support pension. But because he's going to receive $1 million, he gets kicked off. He's got to pay the medication at the full rate, and he's screaming blue murder, going, "Well, what do I do? How do I structure all this?" Where if it was done properly at the start, that could have been sheltered away and supported him moving forward as well. Given his mental capacity, he probably shouldn't be in charge of $1 million either.
Let's face
Um,
it.
yeah, me knowing the situation, he shouldn't be in charge of $1 million, and I can see that not lasting too long. So that's the other aspect of it as well, right? So one, to keep you on the pension, disability support pension, and two is, hey, if they're on a disability support pension, do they have the mental capacity to deal with $1 million lump sum coming from the state?
Yeah. So what can you go and do to effectively manage that more effectively?
Yeah, there's a few different things.
Yeah, what, for example, how highlight how well a thought out estate plan can make a substantial difference in how your legacy is handled and perceived by those you leave behind, or in this situation, for those that receive a disability or on disability support pension,
Yeah.
received a lump sum payout. What are the ways and what are the areas that they should be concentrating to make sure that that income payment keeps going and it's being managed more effectively?
So there's a few different ways, Lionel. First one is if you structure it before it happens, that's always the best. Seeking legal advice, financial planning advice. There could be a special disability trust that could be set up. This gets sheltered from Centrelink, where essentially you could buy a house in there, so you make sure that the beneficiary, in this case, the 50-year-old on the disability support pension, he's always got a shelter. He's always got a home, a roof over his head. He can't access that to borrow against it or anything because he has a loved one that sits on top and manages that trust. Another option is a testamentary trust. Same thing. You have a trustee in place where they manage it on their behalf and distribute money out. So he may get, $200-300 a week rather than $1 million turn up in his bank account at
Yeah,
once.
the testamentary trust is a pretty particular type of trust, but it's created at the time that those who have it in their will, that's created at the time of death. They're
Correct.
transferring all of their assets into this trust called a testamentary trust, and it's got features and benefits inside it to retain and protect the assets within inside the trust. So it's pretty important. It's one of the key areas that an estate planner will sort of guide you to setting up because one, protection of assets, all right, inside a testamentary trust, once you've transferred all of your assets inside the trust. Particularly, you don't really know what happens with relationships these days, Maddie. Like your kid that
Big
you have,
one.
like a kid could be in a relationship and they've been married, they're on the rocks, all of a sudden they've separated, all right? Your wealth's been created, you've passed it to your kid, all
$1
right?
million drops into their bank
Dropped
account.
into their bank account, and then when they go through a separation, they call it a property settlement, which technically means whatever they own, they've got to separate based on what the court of law is going to say, based on whatever the law decides, really. Whereas if you have assets inside the trust called a testamentary trust, then this may avoid some of the property settlement by holding these funds in trust, because technically if they're inside a trust, they've never been distributed to you. So they're sitting inside a trust in beneficiary of yourself, but at the same time, this is a way to protect your assets from getting it caught up in a property settlement. And also, once it's inside the trust, the beneficiaries that receive the money, they're either going to be paying tax or not paying tax. Now, one key thing that I look at for with a testamentary trust is you can pay a minor a tax-free income up to the tax-free threshold through the testamentary trust, which is sort of like a deceased trust. Whereas if you're holding a discretionary trust where you're living and you've got assets through a discretionary trust, you can't pay any funds to a minor up to $416. So there's a few key considerations there to look at when you're thinking about this, but at the same time, always speak to an expert in this field. We sort of just decipher general information in the area.
Yeah.
So yeah, Matty, what else?
Probably the last one I've got, mate, is one of the examples we're going through at the moment, which I found fascinating. You might find boring. but I'm going to go through it anyway.
I'll follow through.
Let's start with some background. So our client, elderly woman, has been experiencing financial abuse from some of her children.
Yeah, that's very tough,
Their
eh?
children are in their 50s, all got their own houses, own families and stuff. These children are trying to secure an early inheritance through manipulation and bullying. To combat this, our client, who is still of sound mind, has decided to adjust her will. She wants to ensure that her estate is distributed in a way that reflects her true wishes and supports the children who have not been, and does not support the children who have been abusive to her. So it was pretty interesting, mate, because initially she's like, I just want to rip all my money out and go bury it in a park where no one can get it. I was like, oh, yeah, before we do that, let's think about some other options. Like, I've thought about setting up a charitable trust.
Yeah.
So we appoint her children in as trustees and we invest the money, and then every year they distribute out the earnings, which should have been their inheritance, to charities each year. So this leaves a legacy, and then her grandkids can come on and distribute money to charities then.
Yeah, but the charitable trust, Matty, can be a great tool for estate planning, but it wasn't really aligned to the client's primary goal. You know what I mean? Which was to ensure her children receive the benefit directly from her estate. So, what other alternative options are there that you could suggest to her?
So the other one we looked at, we explored the possibility of setting up an education bond. So we've spoken about these before, Lionel, but not really for estate planning purposes. It was more for tax minimisation and looking after
Yeah,
kids and things like
yeah.
that. So yeah, this was one way. Instead of it being transferred to a will, it stays in each family unit. So there's 4 family units. They each get an education bond, and then it gets passed on to their children and the grandchildren then. So that was one thing we've come up with.
But that education bond, Matty, can it be challenged through a will or not?
Really interesting. So this is where I learn about
This is the grey area that
this is
can dictate.
nominal. Yeah, it's called nominal estate claim. It can be made under the Successions Act, and it only happens in New South Wales, mate. No other state in Australia, no other territory in Australia.
Are you serious?
Just our lucky state.
So we should give advice to everyone outside of New South Wales on estate planning for education bonds, and it wouldn't come up in the court of law.
Correct. So if the transaction intended to prevent or limit provision from being made out of the estate, which is exactly what we're trying to do here, right?
Maybe.
That's exactly what we're doing, I'm telling you. So this means if the asset transfer is seen as an attempt to avoid rightful inheritance, it can be challenged.
So specifically for a nominal estate claim to be valid, the transaction must have occurred within 3 years of the deceased's death. The law aims to prevent individuals from depriving eligible family members of their inheritance by transferring estate assets shortly before death. So technically what you should be looking at is setting up these types of accounts, education bonds, for the people that you really want to receive the money in a more tax effective way, to be able to transfer to them at a future event transfer date. And you can get around it without having to worry about it if it's been in place for more than 3 years.
Yeah, yep. So pretty special. But from our side of things, we worked with a lawyer in this particular case, Lionel, and we made sure how we divvied up each individual family unit and percentage for the education bond is also reflected in the will. So they're exactly the same percentages. So even if it got challenged and got pushed back to the will, it's exactly the same percentage they would receive. So the lawyer gave advice around that as well, which was pretty good, and we appreciated it as well from my side of things. I wasn't across the Succession Act 2006, mate. I'm not sure if you're across that.
And who is?
Particularly section 80. Section 80 was the key one that I read up on.
What do you mean Section 80? Most people that understand law or just in the general public, they wouldn't even know there actually is sections of the act, which is legislation, that tell you different types of rules inside the law. And Section 80, for example, is what we need.
Covers exactly this.
But what about the implications for a client, Matty? What are the...
Yeah, so given our client's age and the timeline involved, this is a critical point. If she was to set up these education bonds now and she passes away within the 3 years, it could potentially be challenged.
But at the same time, if you have them set up through the estate planning or through the will, and they've notified the actual kids about it and notified them of what it's going to happen, it probably hurts. It doesn't hurt the whole will and estate planning process. It actually helps you understand what's going on. You know,
Given the abuse in this family situation, not all family members.
nah, so for that scenario where there's financial abuse, which is very tough, you know what I mean? It's probably something that's really swept under the rug.
It's pretty crazy because it's been reported to the police. Lawyers have been made aware of it.
In this scenario.
And everyone throws their hands up and goes, not our problem, we can't do anything. And I'm like, that is bizarre. Receiving 30 text messages a day, receiving abusive calls all hours of the night.
You get some of the funkiest shit happens to you.
Mate, I love it because it's really interesting. Like
it's TPD claims, there's elder abuse, there's this, there's that, there's all the technical stuff that comes down to the technicalities throughout to Matty McKay.
So for those people that say financial planners are just about flogging products and investments,
far from it.
Far from it. There's lots of empathy that goes into some of this stuff as well, given the sensitive nature of it. We're not charging by the hour like some other professions as well.
Who's that?
I'm just saying some other professions, mate. Accountants, lawyers. So
what are the alternative? What are some alternative strategies? And
we've had to weigh up the benefits of the education bond against the risk of the nominal estate claim.
So technically, for that, if you just think about it, if you're 3 years from the date that you think you're going to die,
it's tough. No one knows when the clock's going to stop, right?
So, or if you're thinking that you want to gift money or transfer some wealth to people or your estate or your family members in a more tax-effective manner, then these are the questions that we can have answered for you technically. Yeah. So
I think the other part to this, Lionel, with the education bond is one for the estate planning, but also the second part is what's plan B if we move into aged care? If this client gets to the stage where they can't look after themselves, their plan B is they can actually access the education bond capital to actually pay for the aged care facility. So we've had to think about a few different things in this scenario.
Yeah, that's probably the key component with the education bonds. You can access capital within that 10-year period, whereas an investment bond, you can't really do it. Education bonds, with the name itself, it confuses some people that are around it, where the intent for the whole idea of it is for education purposes.
Yeah.
Whether you use that funds for education purposes or not after the intent, it's totally up to yourself. But that's why it's advisable, Matty, to consult with legal professionals specialising in estate planning and elder law to create a robust documentation that supports clients' wishes and demonstrates that these decisions were not made and disherent to anyone unjustly. And also, I would say, more importantly, that once your financial planner raises these areas with you, you should take it into important consideration to have these areas organised and attended to. You know what I mean?
Yeah. So I think it's important, Lionel, to actually pay for this advice from the legal professionals, someone that's specialised in it. Don't look for the cheapest. Look for someone
People
that,
nasties can always be nasty.
yeah. Always look for someone that you can relate to, that you trust, that's been referred to you, and that's really got your best interests at heart. That's not just slipping out a template, which I've seen far too many times. So in summary, estate planning is an essential part of financial planning. It ensures your wishes are honoured, reduces potential conflicts, and can provide significant financial benefits to your kids, your loved ones, and your beneficiaries. Don't wait until it's too late. Start the estate planning process today, Lonnie.
So stay with us as we delve deeper into the specifics of wills, trusts, assets, distributions, and more. Up next, we'll talk about distributions of assets and the potential tax consequences.
Yeah, so we've gone through the tax consequences already. I think the main points we wanted to take out were make sure you speak to your financial planner and your accountant before going to your lawyer, or have them all in the same room to say, this is how we want the assets distributed, especially superannuation, Lionel, especially superannuation, if we can. I've seen before where people have each given a property, but they've got different capital gains attached to them, and they've inherited them, and one person's ended up with more and one person's ended up with less. So understanding the process around that as well is pretty critical at this stage.
Yeah, because once it's set up effectively, you can distribute funds as per whatever's more effective, you know what I mean?
Yeah.
Whereas if you've got no will in place and the rightful people are the two kids and it goes to them individually 50%, you can't really determine how much money they receive or not. And when you're sitting that money inside your own personal assets and you're making income off that, you're paying tax on that income on a marginal tax rate. If you're on a fat income and you're earning good money, then you're going to be paying a lot of tax. There's ways around managing your wealth more effectively, in particular, this estate planning area, like paying income to a beneficiary that's younger than 18 through a testamentary trust is far more tax effective than paying income to yourself when your tax rate's 47 cents of the dollar.
Yep.
Like, it's a no-brainer. It's very simple. But the thing that makes people get so scared about this whole area is just the cost to set it up sometimes.
Yeah.
If you've got a sizable amount of wealth, $1, $2, $3, $4 million of assets, then man, if you've spent a lot of time creating all that stuff, you either have a lot of hard work, a lot of good luck to make all
A
that
bit of
money,
both.
or at the same time you receive the money yourself through inheritance. So, yeah, inheritance, Matty, it's a very common area at the moment with a lot of inheritance, to be honest. I've seen it quite often lately. And it's funny, like the more money that you have, the more decisions and options and your flexibility you have.
But also problems.
And at the same time, problems.
Yeah.
I found that with people that have too much money, it sort of puts them into like a stalemate sort of arrangement where they've got all this money, they want to do this, they want to do that, but they just don't know how to go out and do it. You know what I mean? The doing part and the execution part of the planning side of it is where people receive a lot of value in the advice that we give. You know what I mean? Like us talking about it, of all these great and grand ideas, we actually get to the doing of it and do all the shit.
Yeah.
Whereas most of the time you're sitting in the funds are there, it's sitting in your bank account. Oh, I'm gonna do this.
We need to do
I'm gonna do
this.
that. We
I'm
should do
gonna.
that.
Yeah.
I'm gonna.
I think coming back to the inheritance part, Lionel, we had one about 3 hours ago, a client meeting.
That fresh.
That fresh, mate. It's fresh.
Fresh off the press.
Fresh off the press.
The ink's not even dry.
So husband and wife, they're both in aged care. They both paid their RADs, which is your accommodation bond to get into an aged care facility.
Deposit, yeah.
Yep. So it was 600 grand a pop. But what we've done is the estate planning point of view, is there's an only child that sits there, and they are the sole beneficiary of mum and of dad. If one of them are to pass away, it's not going to affect the other one's age pension or means tested daily fees and all that type of thing in the aged care. So
Yeah.
it was interesting because we spoke to the lawyer around it and said, we don't do it that way. This is what we do. And then we explained why we were doing it and went, oh, I've never thought of it from that perspective. And we're like, that's kind of your profession. Like, feel free to reach out to us because that's exactly what we think about. We think about all the different options and scenarios.
Yeah, the legal side of it, they know their area. The financial planning, strategic side of it, we know our area. So
Yep.
we respect what you do. You should
It's,
respect
it's,
what we do.
it's bringing it all together though, right?
Yeah. But it's that sort of like professionalism on the side of it. It's like financial planners, we know our shit inside out, and lawyers should know this stuff.
Yeah.
But they can't pretend to come into our world and think that they know what we know. They think about things differently than what we do. So we've got the end goal in mind, whereas they're just laser point focused and thinking about the one
Yeah.
transaction. So that's one of the key things as well, distinguishing between professions as well.
Yeah.
Financial planners have a long-term view. Accountants have a historian view because they're looking backward.
Yeah.
And the lawyers are just talking about the one transaction now.
Yeah. Whatever's in their timesheet, getting those fees paid.
Exactly right. So it's important to work and have a good solution for your overall financial areas to make sure it's effective for your plan going forward. So
So I think on that note, we'll leave it there.
thanks, Matty. Well, cracker episode talking about all things death and estate planning.
We could lighten the mood up next week, huh?
Yeah. Hope the listener enjoyed that one. It's not the most intriguing area, but it's important.
Yeah.
So
thank you, listener. Thanks for tuning in, Mum. We'll see you next week.